Okay, so let's go now and take a look at a continuation of the problem that we've been looking at in this particular textbook. Again, you guys need to make absolutely sure that you are able to not only process the differences in the subunits or division operating income differences based on a particular transfer price like you've seen in this video, but you also need to understand how these tax implications will change the decision that the company makes in regards to the transfer pricing that they're going to use between two entities. Again, these tax implications on this intermediate product and the transfer between the two subunits is going to change that decision. Income tax considerations dictate that the total company income will be maximized when the transfer price results in the subunits with the lowest tax rate realizing the largest profit. So in other words, the item with the highest profit, depending on how that scenario works out, and the lowest tax rate being applied to it. So wherever the lowest tax rate is, the larger amount of profit needs to be shown. That way the company pays less in taxes. So you guys have got to be able to understand that concept and apply it. Again, wherever the tax rate is the lowest, you want the highest profit so that you're paying the lowest amount in tax. Managers need to be aware of financial accounting, tax, and other regulatory issues that restrict the prices that may be charged in these situations. Again, if you wanted to go back and pull up the Internal Revenue Code 482 and check out some of that stuff, go right ahead. Think also of the fact that you've got to toe the line when it comes to following those regulations, because if a company steps out of bounds, they will have to pay not only interest on back taxes if they are found guilty of avoiding them, they will also have penalties if it has to go to court and be defended. Of course, there's going to be legal fees. And think also in regards to the bad PR in the media, depending on how large and well known that corporation is. To meet these varying objectives, a company may choose to maintain one set of accounting records for tax reporting and another for internal management reporting. This often raises suspicions among taxing authorities, so companies often resort to other management control techniques. Tariffs are treated in a manner similar to income taxes. Companies have incentives to lower transfer prices for products imported into a country to reduce tariffs on those products. Another consideration by the international arena or those multinational companies is that transfer prices are sometimes influenced by national restrictions on dividends or other income-related payments to parties outside their national borders. By increasing the transfer price, the income can be reduced and more money removed from the host country without being subject to income-related transactions or those restrictions. So again, there's a lot going on in the area of tax and how to manage that for these multinational companies. So let's continue looking at this Horizon Petroleum item. Again, this is page 859 in the text. If we were to go back and pull up our data set that was on the prior pages that I also showed to you in that supplemental PowerPoint that I uploaded, if we were to go back and look at the operating incomes that resulted for the two individual subunits, we're going to plot those in this particular table, and we're going to calculate out what the tax would be on these scenarios. And we're going to calculate which scenario, which transfer pricing method Horizon would choose in order to have the least amount in taxes due. So the first one here is our market price. If we were to go back and look at our tables, we would have seen that the transportation division had a result of $900 in operating income under that first method. And that first method was our market-based method, where it was set at the $85 market price that was known. And the refining division, under that same market price transfer method scenario, their result was only $300. The second one was the 105% of transportation division's full cost. Their operating income result was $380. The refining division, using that transfer price of, let's see, what was it, $79.80, resulted in $820 in operating income. And then finally, under that hybrid one, it was at $600 and $600 operating income. Basically, we split that total. Again, you'll notice that the total operating income for the two subunits of that corporation together always equaled $1,200. It did not change. So under our hybrid one, they split it. What we want to do now is go and apply the tax rates against that. Recall that the transportation division is in Mexico and that the refining division is in the United States in Houston, Texas. So they are having to do some international border crossing, and therefore they're going to have taxes due in the state that's exporting, in the nation that's exporting, and within the United States where we're importing the goods. So, assuming that the transportation division based in Mexico pays a Mexican tax rate of 30% on its operating income, and the refining division based in the U.S. pays a U.S. income tax rate of 20% on its operating income, how would Horizon go about selecting which transfer method? So, how do we want to do this? We want to minimize our total income tax payments between the two countries. So, if we take the transportation division in Mexico's $900 in operating income, and we multiply it times their 30% tax rate, then we're going to get $270 due to Mexico. For the refining division, we're going to take their $300 in operating income result and multiply it times 20% and know that they would pay $60. So $270 plus $60 equals $330. In regards to the 105% of full cost, $380 times the 30% to Mexico would be $114. $820 in the U.S. times 20% would equal $164. $114 plus $164 equals $278. And then finally, the hybrid price, $600 at 30% equals $180, and $600 at 20% in the U.S. equals $120. Adding those two together give us a total of $300. Therefore, which one of these three would we want to do if we were Horizon Petroleum's corporate management in our taxation and accounting office? We would definitely select the 105% of full cost transfer pricing method if it complies with all of those rules and regulations in regards to the IRS code regarding taxes and anything else we may need to comply with in Mexico, because it results in the lowest tax due. Therefore, it would result in the highest net income after we paid those tax expenses. So all in all, in this particular chapter, we covered briefly management control systems and how we go about gathering and using information to aid and coordinate the planning and control decisions throughout the organization. and how we use those to guide the behavior of our managers and our employees. The goal of a management control system is to improve the collective decisions within an organization. The better the information, the faster we're able to access it, the better off we're going to be able to run our organization. In order to be effective, those management control systems should closely align with the organization's strategies and goals. It needs to be designed to support the organizational responsibilities of those individual managers. And it also needs to be able to motivate the managers and those employees to put in effort to attain selected goals desired by top management. Motivation combines goal congruence and effort, where motivation is the desire to attain a selected goal specified by top management, the goal congruence aspect, combined with the resulting pursuit of that goal. And that's the effort aspect. We discussed how effort is not just manual exertion. It is also using the knowledge and experience and education of those folks. We talked about decentralized units of business. We talked about there are benefits to being decentralized versus centralized. Having a decentralized organization creates greater responsiveness to local needs because they're able to act quickly. They are more knowledgeable at that level of the organization than higher up the food chain. It leads to gains from faster decision making, increases motivation of those subunit managers because they're able to do things and learn more while they're working away. It also assists those managers in developing their skills and their knowledge and learning more about the organization. Therefore, they are more likely to be promotable. And it sharpens the focus of those subunit managers within their unit, focusing on how it is performing. However, there are 4 costs to decentralization. Occasionally, it does lead to suboptimal decision making. It tends to focus managers' attention on the subunit only rather than the company as a whole. Many times it increases the cost of gathering information, and it also results in duplication of activities. We also talked about the 3 methods of determining transfer prices: market-based, cost-based, and hybrid. Transfer prices should have the following properties. Again, we've got that criteria chart that you guys want to be able to evaluate items against. We are looking for transfer prices that promote goal congruence, are useful for evaluating subunit performance, motivate management effort, and preserve a high level of subunit autonomy in their decision making. I will continue making the videos for the last 2 chapters. If anybody has any questions or needs additional information, just let me know. You can send me an email or stop by my office. We can make an appointment if necessary. A few final words in regards to transfer pricing and the tax that will be applicable when we're talking about these multinational corporations. Again, to minimize its income taxes, Horizon would favor using 105% of the full cost for tax reporting. Again, though, you've still got to consider those laws that would be applicable. So, the laws in the United States and the laws in Mexico would limit this option. Mexico's tax authorities would challenge any attempt by Horizon to shift income to the refining division through an unreasonably low transfer price. Again, what are we saying here? Mexico has got a 30% rate. The U.S. in this scenario has a 20% tax rate. And Mexico would not be wanting to see that transfer pricing, in essence, taking away from their income taxes that they would be able to get in this transaction from Horizon Corporation. Section 482 of the U.S. Internal Revenue Code, we've mentioned that it governs how multinationals can set transfer prices for tax purposes. It requires that transfer prices between a company and its foreign division or subsidiary for both tangible and intangible property equal the price that would be charged by an unrelated third party in a comparable transaction. We talked about the IRS lawsuit against Semantics Corporation. So let's think about this in applying it to our Houston scenario. If the market price for crude oil in Houston is perfectly competitive, and that $85 per barrel of crude is the going rate, then Horizon would be required to calculate its taxes using that market price, that first line up here. Notice that in our scenario, it has the highest resulting income tax. Horizon might be able to successfully argue, however, that that transfer price should be set below the market price because the transportation division would incur no marketing, no distribution cost when selling crude oil to its own sister company, the refining division. Your book also mentions that under the Internal Revenue Code that Horizon could actually obtain approval in advance from the IRS, and obtaining this approval in advance in regards to transfer pricing arrangements from taxing authorities is called getting an advanced pricing agreement, or an APA. An APA is a binding agreement for a specified number of years. The goal of this APA program with the taxing authorities is to avoid costly transfer pricing disputes. Again, we're talking about lots and lots of time in court, lots and lots of legal fees and CPA fees. And so these corporations want to head that off at the pass if at all possible. So they work on these APA programs and try to get approval in advance for their transfer pricing method. As of the end of 2012, the APA program had completed 1,155 APAs since its inception and had pending requests for another 391 new APAs. In 2012 alone, there were a record of 140 APAs executed, of which 103 were bilateral agreements with other tax treaty countries. Walmart, for example, signed the first bilateral APA between the U.S. and China in 2007. The number of countries that have imposed transfer pricing regulations approximately quadrupled from 1995 to 2007, according to a report by KPMG in 2008. The last global recession pushed even more governments around the world to impose tighter trading rules and to aggressively pursue tax revenues. Again, how do these governments run their operations? Based off the tax revenues that they're able to bring in. Foreign businesses formerly enjoyed favorable treatment in China, but officials there have recently issued new rules requiring multinationals to submit extensive transfer pricing documentation. Countries such as India, Canada, Turkey, and Greece have brought greater scrutiny to bear on transfer pricing, focusing in particular on intellectual property values. Again, we're talking intellectual property, not necessarily an actual good that you can touch. The cost of back office functions and losses of any type. In the United States, the Obama administration plans to shrink a tax gap that the IRS estimates may be as high as $345 billion with a B by restricting or closing several widely used tax loopholes. So going forward, taxation and transfer pricing, especially in the world in regards to the globalization of our economy as a whole, is just going to get more and more involved. Again, this would be another really good area for those of you who are interested in tax, into getting more into learning as much as you can about transfer pricing and international tax law.